There are a few people who signed in or who RSVP'd who haven't shown up yet, so if they come in, I'll try to get them seated and everything so we're not distracting. But I want to welcome you all to the local government program with Dr. Larry DeBoer, Tamara, Ogle, and John Hawley. And I want to just thank everybody for their interest in this program. Is the president of Washington County Farm Bureau, and this type of program is something that we have discussed for some time, and she's been very instrumental in making sure that this happens. Just a few housekeeping things. The restrooms are on the first floor, and so if you need to do that, just use the elevators quick, and you can go down there and do that. There are some cookies and drinks over here, so if you need to get that, or if you need anything, please don't hesitate to ask. Everyone should have got a handout and signed in for me. Thank you very much. I forgot to mention these. I had some index cards. I'll pass some out around. If you think of something, I'm really great about thinking of a question that's not related to anything that we're talking about at that moment, but that I want to ask later. And so I'll pass some of these around in case you have those questions like I do. Anybody think of anything else I need to share before we get started? I'm going to turn it over to Larry and Tamara and John if you want to share anything about you. Many of you participate in the on-the-go government, and we feel like we know Larry and Tamara, even though we don't really ever see them. But we hear you guys, and so we feel like we know you. So welcome to Washington County. Whatever you need. Thank you.
Thank you. We ate before we came, so Chrissy, it was wonderful. We swear it's very beautiful. But I did want to just introduce briefly, this is a modification of a program that we do regionally, so it's usually with multi-counties. We've changed it up a little bit today to add in some things that we don't normally do, but we've kept some of the discussion that we had in that regional workshop. Not all of it, but a little bit. So typically we're at tables, and you have, space to work at and small groups to discuss with. So I'd like to ask you if you can get up and kind of arrange yourself in groups of 4 to 6. That would be great. I'm guessing that when that time comes, you'll want to kind of turn in your chair and talk with the people behind you. So kind of 2 rows, either 3 in each row or 2 in each row would be great. So I'll give you a few minutes to do that.
Just, lay it on its side. That's fine. Find us a place.
Okay. All right.
Are you doing all right?
You're glutton for punishment. Just as well, Dave.
Good.
Hi, how you doing?
Okay, does everybody kind of have a group? Feel like they have people to talk to? Thank you. I know it's uncomfortable to move for some people, so I appreciate you doing that. We usually have highlighters and pens and magnifiers at the tables because, some of these numbers are very small. So if anybody's having any trouble, please let me know and I'll bring you a magnifier, like a writing utensil or something. Just let me know.
Always him.
I'm happy to grab that for you. We will only break, I think, 2 or 3 times. So, but during that time, John and I will be around to help you with questions, to find the numbers, to answer the questions that Larry asks, and to just generally answer questions that you have. So with that said, I'll hand things over to you.
All right, thank you, Tamara and John, and we're really happy to be here in Washington County. Tamara and I coming down, we're discussing the naming of your townships. 7 of them are named after presidents, and it starts with Washington and ends with Pierce, I guess. But there were some presidents skipped, and we wondered whether you just didn't like weights here back in the 1840s, because they seem to be skipped. So that's the kind of thing we talk about while we're driving to our events here. What we're going to do today is to talk about property taxes in Washington County, Indiana, and we're going to start with the budget process. As the property tax, of course, the point of the thing is to fund local government services. So we're going to start with the budget process, and we'll take a look at what local government looks like in Washington County, and we'll run through how property tax rates are set, and we'll ask you to do some comparisons between Washington County and neighboring counties and counties of similar size. And then we'll look at the county government itself and the cities and towns and the school corporations, do some comparisons of those. And then we'll move to the property tax controls, the property tax caps, the local income taxes, and the property tax relief provided by local income taxes. And almost at the end, the property tax bill. So we're going to run through the property tax all the way from the local government funding, from the budgeting, all the way to the property tax bill that gets sent out to the homeowners and the landowners and so forth. And then, and this is something that we have added on for this particular occasion, we're going to apply this knowledge, your understanding of how the property tax works, to a particular issue, and that issue is the assessment and property taxation of farm land, which has been very much the issue over the last 10 to 15 years, and it's likely to be an issue for several years to come. So we'll talk about how that's done in Indiana and what the implications are for taxpayers, both farmland owners and everybody else. You've got your handouts, which is a good thing because there's no way you can read these numbers up on the screen. So I put that up there. That's the first chart of your handout. I put that up there just so you can see what it looks like, but I'm going to talk about it. You're going to want to be looking at the numbers on your sheet. This is what I call a stack of all of the local governments in Washington County. There's 32 of them all together. As you can see, and we've got them listed in the order that we always list them in Indiana. Starts out with the county, and then you've got 13 townships, and the average around the state is about 11. So 13 is a couple of extra townships than the average. You've got 7 that come the cities and towns, right? You've got 7 cities and towns, 1 city, and 6 towns right there. And there's about 550 of those statewide, so the average is more like 5 or 6. So not so many more than usual. 3 school corporations. You can see East Washington, Salem, and West Washington, which is about average for a county in Indiana. The Salem Public Library, and you've got one consolidated public, or you've got one public library here, centered in the city. And then 7 special districts. At the end there, the special districts, fire protection districts, solid waste management districts, and 3 conservancy districts. And so that's the stack. Those are all the local governments in Washington County. What you've got in the first column is total appropriations. And an appropriation is a legal authority to spend. And for those of you who are in the business here, all of these numbers that I'm showing you come from Budget Form 4B, which is the budget form that brings the whole process together. So what happens is that the departments, the agencies of each of the local governments, the county, cities and towns, the school corporations, and so forth, figure out how much money they're going to need in order to deliver services in the coming year, and eventually that produces appropriations. The fiscal body, the county council, the town board, the city council, the school board, they pass a budget, and the budget is a list of appropriations, and over the coming year, the budget year, the appropriations are what they're allowed to spend. Now, I know that sometimes there are such things as additional appropriations during the year, which wouldn't be shown here. And sometimes you don't spend the full amount of your legal authority to spend, and so your spending might be actually less than appropriations. But in terms of looking at the county as a whole, looking at the state as a whole, appropriations is probably the best set of numbers we've got for measuring how much spending actually goes on from local governments. How much of it in the county of Washington County? About $69 million in 2018, scheduled to be spent or already spent here in 2018. The next 4 columns are funds. So appropriations are allocated by fund, and a fund tells you what can be spent? What purposes can the money be used for? The general fund basically can be used for any purpose, but it's dominated, the general fund, the money in the general fund, appropriations in the general fund, dominated by employees. Wages, salaries, benefits for employees, and then other operating costs, office equipment and things like that might be in the general fund. And as you can see, that's the biggest of the funds for just about every one of these local governments. When you add all 32 of them up, it's 45 million out of the 68 million, so about 2/3 of the total is in the general fund. Next is debt, and what debt is you've issued a bond to borrow money in order to build something big. And as you can see, almost all the debt, other than the county, almost all the debt is with the school corporation. So they are building or refurbishing or adding on to school buildings. Now I see that the county's got some debt, and I wonder if that's over our heads here. It's possible, I guess, that perhaps some borrowing went on to do that. Of course, from the budget numbers, I just can't tell what it is, and it's always worth saying that you have to live in a county for maybe 2 weeks to know more about that county than I will ever know. But all I've got are these numbers, and that's what I'm looking at. So debt is, we've issued a bond, and now we have to pay the money back. And you usually pay it back over 10 to 20 years, depending on the length of the bond, and you raise the money usually from the property tax. So we're going to schedule bond repayment over 10 or 20 years, and we're going to tax every year in order to meet that bond repayment. And that's what's included here in debt. So it's appropriations for debt service and repayment of principal. Next comes cumulative funds or capital projects funds. And these are kind of the opposite of debt in a sense. These are sort of savings accounts. We're going to save up over the course of several years with a cumulative fund. And then we're going to buy a fire truck, or then we're going to refurbish the fire station, or something like that is the sort of thing that would be done. The school corporations and the libraries, however, don't have cumulative funds. They have capital projects funds. And there's a similar idea, although the idea of saving over several years is less likely to be done with a capital projects fund. Capital projects funds, especially for schools, are for smaller capital projects. So you issue a bond to build an elementary school, use the capital projects fund to buy the playground equipment. That would be the kinds of things that you would differentiate between debt and capital projects funds. So capital projects funds, as you can see again, the schools have the bulk of that money right there. And then everything else, other operating. So there's dozens and dozens of other funds that the various counties, cities and towns, and school corporations have. And we add them all together, and you see it's about $13 million all together in Washington County. And those are dominated by transportation. For the cities, the towns, and the county, most of that money is going to be roads, streets and roads, highway construction, highway maintenance, that sort of thing. For the schools, most of that other fund money is buses. And there's two different funds. There's a fund for buying the buses, and there's a fund for operating the buses. So you buy the bus with one fund, and you buy the gas and pay the bus driver with another fund. And that's what most of the other operating is for the schools. So general debt service, cumulative capital projects funds, and all the others together add up to the total appropriations for each of these local governments. Then comes the property tax. And as you can see, property taxes, Washington County, about $22 million out of the $69 million of total appropriations. So it's about a third of all the appropriations paid for with the property tax levy, which is the revenue collected from the property tax. That's a little lower than most counties or most places in Indiana, usually more like 38, 39, 40% of appropriations paid for with property taxes. So Washington County, a little less intensive user of property taxes than most places. And the property tax levy, that's the amount that is collected from taxpayers used to pay. Or at least, I'll say this and you'll see why in about an hour. Why I say it this way, the property tax levy is the amount that the county, the cities and towns and school corporations and all the others intend to collect from the property tax. So intentions and what happens are sometimes different. Net assessed value, that's the tax base. The tax of the the assessor, county assessor, goes out and figures out how much, what price would you put on the value of property? What is the taxable value of the property? And we tax land, and we tax buildings, and we tax business equipment in Indiana. That's basically it. There used to be a lot of other stuff got included in the property tax, but we're now down to land, buildings, and business equipment. And it's the assessor's responsibility to figure out what is the taxable value. And the standard that we use these days is objective measures of property wealth, which we've decided is also called market value in use. That is, you figure out what would be the selling price of the property if you sold it today for the use that it is being currently used for. And so for a house, even if the house is located in a place where you could have commercial development, you assess it as a house. How much could it sell for as a house? And that's the market value in use. And so this was the big controversy about 15 years ago. Supreme Court said the old way we were doing it wasn't good enough, was unconstitutional, and that we had to go out and figure out a new way to assess, one that took account of actual selling prices, actual construction costs, and that's what we do now. So net assessed value, just over $1 billion in Washington County. Now you take the property tax rate, and as you can see it's 2.1811, and we express that in Indiana as dollars per $100 assessed value. So when we say 2.18, we usually say $2.18. It's a $2.18 tax rate on average in Washington County. And that means that $2.18 out of every $100 of assessed value is paid annually in property taxes by the property owners in Washington County. And if you pay $2.18 per $1 billion in property taxes, you will raise $21.9 million in property tax revenue. So the rate times the net assessed value is the property tax levy. If you look down that column, you can see the property tax rates for all the units of government. And of course, you live in Washington County, so you pay that rate. And you live in the townships, you pay whichever township rate. And if you live in a city or town, you pay that rate. You pay one of the school corporation rates. If you live in the Salem Public Library District, you pay that rate as well, and it adds up to the total rate that you pay. So that's what you're looking at here as far as the overview of local government in Washington County. Now let's take a look at how the property tax emerges from the budget process. And here's how it works. The local government figures out its appropriations. The budget process would start in the spring or in the early summer, and the agencies of the county, and the sheriff's office, and the auditor's office, and the road and street people, and everybody, they get together and they figure out how much money am I going to need in order to do the job that I've been assigned to do, in order to deliver the services that we need to deliver over the coming year. In 2019, for example, they're starting to work on that budget now. In 2019, how much money are we going to need, and then it gets added all up, and we figure out general fund appropriations, debt service appropriations, capital projects, accumulated fund appropriations, and so forth, and we say this is the amount of revenue, this is the amount of money that we need to spend next year in order to deliver services. And then they subtract off miscellaneous revenue, and it's called that in Indiana documents, miscellaneous revenue. And what miscellaneous revenue is all revenue that isn't property taxes. And so the local income taxes get subtracted off, and the charges and fees, and the motor vehicle excise tax is subtracted off, and any state aid that might be received, and any federal aid that might be received, and fines and fees and interest earnings and sale of property, and all of that stuff gets subtracted off of the appropriations, and what's left over is the amount that must be raised from the property tax. Now, back before about 1973, we would have stopped right there and said, you know what? Property tax is the residual revenue source. If we can't raise it any other way, we're going to get it from the property tax. But a governor by the name of Governor Bowen, looked out and observed that under that system, property taxes were rising rather rapidly. And he said, you know what? We're going to put a limit on this. The maximum levy was invented. And the maximum levy is the maximum amount that local governments can raise from the property tax in any particular year. And so what happens now is the property tax levy gets compared to the maximum levy. And the enforcers of this thing is the DLGF, the Department of Local Government Finance, which is the state agency which administers and oversees the property taxes. So the employees of the DLGF come and they take a look. How much did you say you wanted to raise from the levy? What's your maximum levy? And sometimes the amount that you wanted to raise matches up with the maximum that you can raise, but often enough, the first pass at the process, the property tax levy turned out to be greater than the maximum. And what happens if the property tax levy is greater than the maximum? Well, you have to reduce that levy. You look at the formula, how can you reduce that levy? Well, you could go out and find some additional miscellaneous revenue, but if there's additional miscellaneous revenue, why didn't you count it in the first place, right? So that's not the usual thing. The usual thing is, all right, what appropriations must be cut? And so when the DLGF person comes in and the local reporter says, the DLGF person says we have to cut appropriations, yes, that's essentially what has been said, right? Your levy's coming in ahead of the maximum, above the maximum, and the only real option is to reduce appropriations. And so you tell the sheriff's department, you can't have that extra squad car. You tell the road and street people, you can't have you can't have the extra earth mover. Whatever it might be, appropriations are reduced until the levy gets down to that maximum. Well, how do we figure out what the maximum levy is? And that's where this chart comes in. And the maximum levy is a percentage increase in your last year's maximum levy. So we started out with maximum levies in 1973, based on what the property tax was at that time, and since then we've been increasing it by particular percentages. And these days, since 2002, here's how we make the calculation. The blue bars that you see up there are annual growth rates of Indiana non-farm personal income. And this is something that the U.S. Commerce Department measures for every state. And so we take a statewide number and we say, how much has income been increasing year after year after year? And then we take a 6-year average of that growth rate. And you see the growth rates up there. There's a high one above 8% there in 1998. There's a negative one in 2009. That's the Great Recession. There was a low one in 2013. There was a particularly high one you see in 2011 that I've got in red there at 6%. So varying between, well, one negative number, but usually varying between about 2 and about 5% growth every year. We average together 6 years. We average it together with a 2-year lag. The reason for that is they just announced a few weeks ago the maximum levy growth quotient for 2019 as guidance for local governments in their budgeting process. And they want to know, how much can we increase our property tax? And they said, well, 3.4%. The data that went into that calculation is the most recent data available. So the 3.4% applies to budgets in 2019. They can increase the levy 3.4% in 2019. But they had to announce it in 2018 because that's when the budget process is taking place. And the most recent data available is from 2017 and 16 and 15 and 14 and 13 and 12, right? 6 years average. So from 2012 to 2017, those growth rates were averaged together, and 3.4% is the result. So numbers through 2017 determine how much the levy can increase in 2019. Well, what makes it change from year to year? Well, what happened for 2019? It's a rolling average. So for 2018, we used numbers from 2011 to 2016, average those together. 2019, we dropped 2011 and added in 2017, a rolling average. Well, what number did we drop? We dropped 2011. It's in red up there. 6%. We added in the growth rate for 2017. What was it? 3.3%. So we dropped a big number, added in a small number, the average went down. The average went down from 4%, which was the assessed value growth quotient or maximum levy growth quotient for 2018, down to 3.4% for next year. So property tax restrictions, the amount that the levy can rise next year, will be lower than it was this year at 3.4%. As we move forward, what do we expect? Well, what do we got? We got inflation rates here about 2%. We've got growth rates in the 1.5% to 2% after allowing for inflation. So somewhere in the 3.5% to 4% range is where we expect to be over the long haul. Now, why do we do that? Why do we take income numbers and use it for the property tax? And I think the justification for doing that is the idea that income, that property taxes are paid out of income. Now, you don't sell off a piece of property in order to pay your property taxes. Usually you don't do that. You pay out of income. And so if the levy is going up, we kind of like to keep the increase in the levy consistent with the ability to pay of Indiana taxpayers. So we measure the ability to pay by how much their income goes up, and then we say, over any 6-year period, the levy can't increase any more than that. And so what we're trying to do with this formula is to match the increase in the property tax with the increase in people's incomes. That's the idea. And trying to keep those even, trying to make sure that the property tax doesn't rise much faster than the ability to pay of Indiana residents as a whole. Now, your mileage may vary. Obviously, the Indiana total number, the state total number, includes Hamilton County and Marion County and Crawford County and Warren County, so some very big urban areas and some very small rural areas, some very wealthy areas, some not so wealthy areas get mixed in together in that number, but we all use the same number, 3.4% is what it's going to be for next year. All right, so where do the tax rates come from in that process? So we figured out the levy, we've compared the levy from the appropriations process to the maximum levy. We've come out with the amount of revenue that we're going to raise. Then we set the tax rate. So meanwhile, while we're figuring out this levy through the budget process, the assessor is out there working and figuring out what is the assessed value of property. I send out a notice every year, a Form 11 every year, to folks to let them know what their assessed value is. It can change every year. You take that, you add up the levy, you add up the net assessed value, net after all the deductions, the assessed value after the deductions, you add it up for the particular jurisdiction that we're talking about, or the city, within the whole county, within a township, within a school corporation. We add up the net assessed value, then we take the levy, the amount that the local government wants to receive. We divide that levy by the net assessed value, we multiply by 100, and that's the tax rate. What that means is there's a different property tax rate for every unit of government in the state and in the county, and there is a change, usually a change in that tax rate. It changes every year, depending on how the change in the levy and how the change in net assessed value worked out. If the levy rises faster than the net assessed value, the rate's going to go up. If net assessed value rises faster than the levy, the rate's going to go down. And that's where the tax rate comes from. So the property tax is kind of different, and sometimes you got to kind of put taxation on its head in order to figure out how this works. With the sales tax, we set the sales tax rate at 7%, and it's going to be 7% year after year after year. We multiply that 7% by taxable sales in the state, whatever that happens to be, and that's the sales tax revenue we receive. That's not the way the property tax works. With the property tax, we set the levy first. Here's how much we want to raise. And then we say, here's the tax base, assessed value. What rate do we need to raise that revenue from that particular tax base? We set the rate anew every year with the property tax. Okay, so that's the budget process. That's how we set the tax rates. Let's take a look at what the tax rates are in Washington County and how they compare to some of your neighboring counties and how they compare to 4 counties here that have populations near the 27,827 that we have here in Washington. This is where we're going to have some discussion. All right, so I'm going to ask you some questions after I show you what's on this chart. So we want to look at the top half of the chart, chart number 2 on your second page. And what you see across the top is the data for Washington County. And the first number you see is population. And then the population, this is from the U.S. Census. And what I've done is to take the total appropriations and the fund appropriations and the levy and the assessed value, and I've divided that by population. So you've got it per person or per capita. And that allows us to compare big counties to small counties, putting them all on the same per person basis. So the number you see up there, 2473, that means that all of the units of government in Washington County, all added up, county government, cities and towns, townships, school corporations, library district, and everything, all added up, divided by the population, is $2,473 in appropriations in authorized spending per person. Of that, 1,622 is general fund, and 221 is debt service. And we raised $789 per person from the property tax on a net assessed value per person, that is the tax base per person, of $36,191. That gives you the average tax rate for the whole county, all the units in the county, the average tax rate, $2.18 for $100 assessed value. You see that for your neighbors, Harrison, Jackson, Lawrence, Orange, and Scott. You see that for 4 counties with comparable population. That is the 2 counties that have populations just under Washington and the 2 counties that have populations just above. So those are comparable populations. And we do that just because, well, when you do the Indiana average includes Marion County and Allen County and Lake County and Vandenberg and Hamilton, all these great big ones. And that includes Ohio and Union, all these tiny little ones. How about some counties that are similar in size, similar in what needs to be done, what services need to be provided, what revenues are available? Jennings, Wells, and Ripley are those. Okay, what questions? This is the table I want you to look at. Here's the questions. Where's the questions? Here's the questions. Wait, before I do the questions, ooh, I forgot. I almost forgot. Last page. Okay, so now you can compare to surrounding counties, similar sized population counties. What about comparing to the whole state? Well, I could give you pages and pages of every county, but instead, what we've got at the top of the last page on your handout, you'll see Table 9, statewide percentiles for tax and budget comparisons 2018. And these are percentiles, so 10%, 25, 50, 75, and 90. And take the total appropriations column, for example. At the 50th percentile, 2735, that is, half the counties have appropriations per person higher than that, half the counties have appropriations per person lower than that. 90th percentile is 3186. If you're above 3186, you're one of the highest 10% of counties. The lowest one of the 10 percentile, 2249. If you're under 2249, you're in the lowest 10% of counties. So the percentiles will allow you to compare your numbers or anybody's numbers, your numbers or anybody's numbers to the totals. We put it last, so if you want to, you can tear it off and have that sheet and put it right next to the numbers that you're looking at. So feel free to tear off that last page if you like. I know some people just can't bring themselves to tear off a page, but that's why we did it that way. We put it last so you can tear it off. So now, that's what that is. Questions, discussion, tables 2 and 9. How does your total appropriations per capita compare to your neighbors? The counties with similar populations and statewide percentiles. So take a look at the total amount of spending, of authorized spending in the budget. How do you compare? Are you high? Are you low? Where are you? And so compare it to counties with similar populations, to your neighbors, and then see if you make head or tail of the percentile table and see where you rank among all the counties in the state. What appropriations categories contribute to total appropriations? Are you high or are you low? How come? Is it the general fund, the capital projects fund, debt service? What is it? How do your total levy and net assessed value compare? Are you raising a whole lot from the property tax or only a little? And what about assessed value per person? Right? How much property have you actually got out there to tax? And then, last column, when the rubber hits the road, as they used to say, the average property tax rate, the rate that you pay. You have a high rate, you have a low rate. It's the average for the county across all of the units of government. The idea here is to discuss for a while, which is also the time I stop talking, which is a relief to everyone. I know. So let me stop talking for a minute, take a look at these questions, take a look at your data, and see what you think. Talk it over with your neighbors. and we will be around to answer questions about the data. So what I see up here, and some of the things that, some of the kinds of comparisons that I like to make, and that is, where does this tax rate come from? $2.18. And you take a look, and so how does $2.18 compare? Well, it's pretty close to the median, actually. The median across the state, the middle value for all the counties in the state is $2.11. So you're just a little bit higher than the median. So this is a $2.18. This is a typical tax rate for counties, for all the local governments in a county across the state. So nothing particularly unusual there. But if you took a look at the property tax levy, $789, $789, that's in the lower 25th percentile. So you're not raising that much. So how can you have an average, normal, typical tax rate and not raise an average, normal, typical amount from the property tax? And the answer is that net assessed value up there. The net assessed value of $36,191 is also in the lower 25th percentile. So there's less property to tax in Washington County than there is in the typical county. So you can have a normal tax rate, a typical tax rate, times a relatively low net assessed value, you get yourself a relatively low property tax levy. And that's one reason why your appropriations, as you can see, are relatively low as well. 2473 is right about the 25th percentile. Now you use the property tax a little less out of total appropriations in Washington than most counties do. And so you can have an appropriation at 25 with the levy less than 25th percentile, but nonetheless a conservatively spending state, a conservatively taxing property tax levy with a typical property tax rate. And that's a comparison that I like to make. When you talk about the property tax rate, I think people tend to think of, well, the money gets raised and the local government spends it. And if the tax rate is high, well, they must be spending a lot. And that could be true, but you also have to pay attention to that assessed value per person. And the assessed value per person, I think, is kind of a significant number. If you think about it, the people are the service population, right? The local government is providing services to the people. And so that's where the spending goes. The revenue, at least the property tax revenue, comes from the assessed value. So if you compare the assessed value, what can be taxed, to the population who needs to be served, you've got a rough measure of what you might call your fiscal capacity, your capacity to raise revenue to deliver services given your population. And so the fiscal capacity to tax to deliver services in Washington County, relatively low compared to other places. Let's take a look at Decatur up there. Oh, even better, Wells. Let's look at Wells. Right, look at that tax rate, Wells, the third one down under comparable population. Same kind of population, same kind of folks, same number of folks anyway to deliver services to. They do it with $1.34 on their property tax rate, which is in the lowest 10 percentile. That's a very low property tax rate in Wells County. They raise $733, which is a little bit less than what you raise. How do they do that with such a low property tax rate? Well, look at that assessed value per person. $54,515 puts them at the 75th percentile. They've got a high assessed value per person, greater fiscal capacity than Washington County has. But you take a look at Jennings. Jennings, you'll notice, raises $690 per person, $100 less than you guys, but they do it with a higher tax rate, $2.23. Why? Because their fiscal capacity, $30,000 per person in the lowest 10 percentile. So when you're thinking about property taxes, remember you're thinking about the rate and the levy and the assessed value. The assessed value just important as the amount of revenue gets raised in determining what the tax rate might be. Okay. Well, the second half, the lower half of Table 2, gets at the actual units of government. Now, the numbers that we just looked at are really good for comparing across counties because some counties have more towns, some have less towns, some have a lot of school corporations, some have only one. And so you add it all up and put it in per capita terms, you can make comparisons across counties. But the units you're really interested in are the actual units of government. The county government itself, the city and town governments, the school corporation governments. And that's what you have listed at the bottom of this chart. Now that means we left off the townships and the library districts and the special districts. So my apologies to those folks whose primary interest are those local governments. County, city, or town, and schools make up, usually in most counties, about 90% of total appropriations. So we focus on those. And so, again, you've got population for the county, the towns, and the city. You can't get population for the school corporation. Census doesn't do that. And so what we've got up for the schools, and this is important to remember, okay, what we've got up for the schools there is enrollment. So whereas the population of the county and the cities and towns includes everybody, adults and children, the school numbers include just the kids. Right? So that means that the numbers between the schools are not comparable to what's in the towns and what's in the county. So do be careful of that. Total appropriations in general and debt and all the categories of appropriations, levy, assessed value are again on per capita terms given the population of the particular unit. For the schools, they're on a per pupil basis, per student basis. And so if you want to compare the schools, you must compare the schools to one another, not to the town, not to the county. Okay, so what are you going to compare them to? Well, you've got the units here from Washington County. What we've got at the back of Table 9, the next three tables, on that first page of Table 9 are the percentiles for the county governments, the city and town governments, and the school corporations, all on a per person or per pupil basis. And so that's the comparison you can make. You can make the comparison of your county's units to the statewide percentiles. That is, are you high or low relative to similar units in the rest of the state? The percentiles will tell you that. So we want to ask similar questions. Right, first of all, hey, look back at Table 1, just briefly, first question, and say, which units spend the most? Which units spend the least? Where are the authorized appropriations in Washington County? And then on Table 2, pick a unit that interests you, and from Table 2, compare that unit's property tax rates to the statewide percentiles. High property tax rates, low property tax rates, or about in the middle at the 50th percentile. Are the county, city, or town and school tax rates high, low, or typical? And then see if you can figure out why the rates are high or the rates low. Is it because the levy is high, they're collecting a whole lot? The levy is low, they're not collecting much? Is it because the assessed value per person or per pupil is high or low? What has made it? Or what about appropriations? Maybe they're just spending a whole lot, and that's why they need more property taxes. Or maybe they're not spending very much, and that's why property taxes can be lower. So figure out those questions, discuss your findings with the group, and in a few minutes after that, we'll take it back. Now, you gotta ask, is that fair to Salem schools? Their tax rate is almost exactly the same as East Washington schools. It's about $1. That's an average tax rate. Salem loses 7.8%, $344,000. East Washington loses 0.4%, $13,000. What's the difference? The difference is Salem School Corporation is inside Salem, and East Washington isn't. Salem School Corporation is in a district that has a high tax rate because it's in the city. East Washington does not have a high tax rate because it's outside the city. Through no fault of their own, through uncontrolled by what the school corporations can do with their budget, Salem City Schools have to make do with less than East Washington. Salem loses more than East Washington does. And this is the kind of result of the one-size-fits-all feature of the tax caps, that 1%, 2%, 3% applies whether you're in a city, whether you're outside a city. And it also means that if you're in a city, your taxpayers have a higher tax rate, they're going to have more tax cap losses, and you're going to share in that. And this leads to a story I always tell. When the tax caps first came in, I was talking to a school superintendent in Allen County, up by Fort Wayne, surrounding Fort Wayne. And he looked at his tax rate and looked at the tax cap credits and saw that his tax rate was under $2. And he says, you know what? No problem. I'm not going to lose any revenue from the tax cap credits. And then Fort Wayne annexed his territory. Now the Fort Wayne city tax rate applies to his taxpayers. Now instead of $1.70, his tax rate is $3. Now, lots of his taxpayers are over their caps, lots of them get tax cap credits, lots of them are paying less than their full tax bill, and the school corporation shared in some of those losses, simply because they're now in a city where before they weren't. That's how the tax caps work for school corporations and other local units. Okay, well, let's take a look at the local income taxes. Why look at the local income taxes when we're talking property taxes here? Because we're heading for the tax bill, and there's one aspect of the local income taxes that apply to property taxes, and that's true here in Washington County. You've got a local income tax, a LIT, for property tax relief. That is, you've got a $2 income tax rate, and if you want to compare that to the state, we've got a table of percentiles in the back. A $2 rate, and of that, 1/4%, which raises $1.17 million, is used for property tax relief. That is, we buy down the property tax with income taxes, or we allow taxpayers to pay less in property taxes, and we make up the difference in local budgets with the income tax. Let me show you how that works, how that calculation is done. And there's the whole of Table 7. But I picked out the important points and put them in bigger print right here. Property tax relief, we're raising $1,170,000 in 2018 from that piece of the income tax. And then the county council, it would be, had to decide how to allocate that property tax relief. And there is no master list, unfortunately, of these rates of what the counties have decided. And so I have to back the numbers out of the numbers I've got. And so these are estimates, but the numbers seem to work out that about 54% of the tax relief goes to homesteads, and 46% goes to non-homestead residential. That is, half of it, about half, goes to owner-occupied primary residence, owners of that kind of property, and about half of it goes to all the other kinds of housing that there is, rental housing, second homes, vacation homes, retirement communities, and all of that stuff. So half and half, approximately half and half. And so we take that $1.1 million and we divide it in two, and we say we're going to give $627,000 in local income tax relief to homesteads and $542,000 to non-homestead residential. We then look at how much property taxes are paid by each of those property types across the county. And for homeowners, it's $4.7 million. And so we take the $627,000 divided by the $4.7 million, that's 13.7%. $542,000 divided by the 3,663 non-homestead, that's 15.37%. Which means that homeowners will get to subtract 13.7% off their tax bills, and non-homestead residential rental housing owners will get to subtract 15.37% off of their tax bills. That's a part of the property tax that they don't pay. But in this case, we replace the money in local government budgets with the income tax revenue. So if a homeowner pays 13.7% less than their tax bill, we take that amount out of that income tax at $627,000, and we say to the local government, here, we've just replaced what would have been paid with the property tax with income tax instead. So what the local income tax for property tax relief really is a shift in how services are paid for in the county, a shift away from property taxes and towards income taxes. All right, now, that may become clearer if we look at a mock-up of some homeowner tax bill. And that's what you see on table 8. And so what we've done here, we've taken a couple of different taxing districts, the Madison Township Taxing District that has a tax rate of $1.73, and the Salem City Taxing District that has that tax rate of $3.70, and we have put 2 different houses in each one. $83,000 house and $166,000 house. Now, $83,000, a couple of years ago when we had the numbers, that's about the average homestead assessed value in Washington County. $166,000 is double that. So we've got a median or a medium average house value and a higher house value for Washington County. So how do we calculate a tax bill? Well, let's look at that first column, Madison Township. We take the $83,000. The assessor has said, if you were to sell your house tomorrow, you could probably get $83,000 for it. That's what the assessed value is supposed to mean. We take the homestead standard deduction. We subtract. It's $45,000. We subtract $45,000 from the $83,000. That leaves $38,000. That's a deduction that all homeowners, all owners of homesteads, get $45,000. Remainder is $38,000. We then take 35% of that $38,000, the remainder, and that's $13,300. And we're going to subtract that amount as well. And then we're going to subtract the mortgage deduction as well. If you've got a mortgage, you can subtract the mortgage deduction. And that's $3,000 right there. So $83,000 minus $45,000 minus $13,300 minus $3,000, taxable assessed value $21,700. Taxable assessed value less than 1/3 of the market value or gross assessed value of the house. That's how we deliver tax relief to homeowners in Indiana now. In the past, we've used different systems, but these days, we simply don't tax more than half of all homeowner value in the state of Indiana. Property tax relief for homeowners in that way. So then we're going to take the $21,700, we multiply by the district tax rate, $1.73 per $100 assessed value. You could interpret that as 1.73% if you like. And that's $377. The property tax bill is $377. And then we take the lit credit. And again, it says LIT credit. One of these things will get that totally fixed. Because LIT was what we used to call it, now it's lit. But the lit credit rate of 3.75%, 3.75 to 377, that's $52. Subtract the 52 from the 377, $325. And then, after doing everything else, the last step is to compare how much you have to pay to your tax cap. Now the tax cap on $83,000, 1% for a homestead, is $830. The tax bill there at $325, way less than $830. No cap credit is needed. This taxpayer pays $325 in property taxes. Now I've gone through that whole thing. You can do that for your property as well, because every year the auditor sends you this information. There's an 8.5 by 11 sheet that comes to every property owner every year that lists how your property tax is calculated in exactly that form. And it really is, you know, I can remember the day, 30 years ago, when they didn't send you anything, but if you went down to the courthouse and asked, you could get this little slip of paper, and it was a different slip of paper designed differently in every county, and the little slip of paper had all sorts of abbreviations and jargon on it, with all sorts of numbers, and if you knew the abbreviations and jargon, you could understand what it says, but there wasn't a key on the thing. Virtually impossible for any taxpayer to figure out what the heck was going on. We've made great strides since then, and if you understand a little bit about how the system works, you can figure out exactly why you pay, or why they're asking you to pay what they're asking you to pay from the property tax. So take a look at that form, and you can see that calculation. Well, let's take a look at the last column there. That's the higher valued home in the high tax district. So $166,000 gross assessed value, you subtract the $45,000, same amount, even though the value of property is higher, and that leaves $121,000. And then 35% of that is $42,350. Same mortgage deduction of $3,000, but the taxable value is $75,650. Now that's a little less than half of the total. So it's a much higher percentage of the total than it was for that low value house. And the reason for that is that the standard deduction is fixed at $45,000. For an $83,000 house, $45,000 is a lot. For $166,000, it's still a lot, but not nearly as significant. If you can imagine $1 million house up there, and there are a few in Indiana, $45,000 is a drop in the bucket as far as reducing their property taxes. So there it is. The $75,650, we're going to multiply it by 3.7% or $3.70 for $100 assessed value. That's a gross tax bill of $2,806. We're going to subtract off the 13.75%, which for this homeowner is $386. That leaves $2,420. And now we compare that to the tax cap. 1% of $166,000 is $1,660, which is less than the tax bill of that homeowner. So that homeowner gets a tax cap credit of $760, which we subtract from the $2,420 to bring it down to the cap amount of $1,660. That's how the tax caps work. So what is the tax cap? It's a tax break for this homeowner, a significant tax break for this homeowner. This homeowner is paying $760 less in property taxes because of the tax cap. And it's revenue losses for the local governments. That $760 would be divvied up between the county and the cities in town and the Salem City and the Salem School Corporation and the township and the library district as well. They would all end up collecting less from this taxpayer than they levied at that $3.71 rate. So it's a tax break and it's revenue losses, both sides of the budget. And that's how it works. That's how the budget, how you start with the budget, you go through the process, you come out with the tax bill. Now, let's take a look at an issue. And knowing how this works, let's look at the assessed value of farmland, and in particular, the ongoing reduction in the assessed value of farmland, which is happening in Indiana right now. Okay. So here's a plot of what's called the base rate per acre of farmland. And that's the starting point of the assessment of farmland in Indiana. The Department of Local Government Finance, the DLGF, every year recalculates the base rate. And they use a formula, and I'll show you a little bit about what the formula looks like here in a minute. But the formula is based in part on commodity prices, prices of corn and beans, and in part on interest rates. Along about 2007, the base rate at that point in 2007 was $880 per acre. Along about 2007, prices of corn and beans started to go up, and interest rates, because of the recession, started to go down. And commodity prices are in the numerator of this formula, and interest rates are in the denominator. The numerator was going up, and the denominator was coming down. And if you remember your arithmetic, that means the quotient starts to go up. The base rate of farmland climbed from $880 in 2007 to $2,050 in 2015. Over 8 years, it more than doubled. And we knew it was scheduled, under that formula, it was scheduled to go up to about $3,000 by next year, 2019. And that would have been more than triple. And so, if you own farmland, you would have noticed that your tax bill had begun to rise rather significantly in 2007 and all the way up into taxes payable for 2015. Well, the legislature took notice of this. Farm Bureau helped them take notice of this, and they changed the formula. And it was frozen at 2050 in 2016, and under the new formula after that, it started to decline. It went down to 1916, 2017, 1850 for this year in 2018, and the DLGF has already announced it's going to be $1,610, $1,610 per acre in 2019. Taxes payable next year in 2019. So how does that happen? Here is the calculation, and I'm not sure how much detail you need to know about this, but what you've got in that first column is 6 years. 6 years of data. So once again, we're going to average together 6 years. 6 is the magic number for averaging stuff together in Indiana, apparently. We take numbers on cash rent. And this is a survey that's done by our own Department of Agricultural Economics at Purdue. They take a survey to figure out what cash rents per acre are for those who rent their land. And you see that's cash rent per acre, and they subtract off the property taxes that are paid.